Ever wondered how ordinary people quietly become millionaires while everyone else is just working for a paycheck? The answer for many of them isn't luck, inheritance, or some secret club. It's stocks. But here's the problem. Most people hear words like stock market, shares, or investing and instantly feel confused or intimidated. So today, let's break it down in the simplest way possible. A stock is simply ownership in a company. That's it. When you buy a stock, you're buying a small piece of a real business. Imagine your favorite company is like a giant pizza cut into millions of slices. Each slice is a share. When you buy one share, you own one slice. The more shares you own, the bigger your piece of the pizza. It's not just a number on a screen, it's real ownership. Now you might be thinking, why would a company sell pieces of itself? Because companies need money to grow. Let's say someone wants to start a tech company. They need money for offices, employees, marketing, and product development. Instead of borrowing from a bank and paying interest, they can sell shares of the company. Investors give them money, and in return, investors get ownership. If the company grows, those shares become more valuable. If the company struggles, the shares lose value. That's the risk and reward. Let's make this even clearer. Imagine your friend starts a burger business worth $100,000 and divides it into 100 shares. Each share is worth $1,000. You buy one share. If the business grows and becomes worth $500,000 in a few years, your one share is now worth $5,000. You turned $1,000 into $5,000 simply because the business grew. That's how investing builds wealth. There are two main ways people make money from stocks. First is price growth. If you buy a stock at $50 and later sell it at $100, you double your money. The second way is dividends. Some companies share a portion of their profits with shareholders. It's like getting paid just for owning the stock. Not all companies pay dividends, but many stable, established companies do. Now let's talk about something important: risk. Stocks can go up, but they can also go down. In the short term, the market moves like a roller coaster. Prices rise and fall daily based on news, emotions, and global events. But historically, over long periods of time, the stock market has trended upward. This is why long-term investors usually win. They don't panic during crashes. They stay invested and let time do the heavy lifting. You've probably heard of stock exchanges like the New York Stock Exchange or Nasdaq. Think of them as giant online marketplaces where people buy and sell ownership in companies. Today, you don't need to be rich or wear a suit on Wall Street. You can invest directly from your phone using apps. That's how accessible investing has become. There are also different types of stocks. Common stock is what most people buy. It gives you voting rights and the potential for higher growth, but also more risk. Preferred stock is more stable and often pays fixed dividends, but it usually doesn't grow as much. Beginners typically focus on common stocks or even index funds, which spread money across many companies to reduce risk. So why do stocks create so much wealth? Because of compounding. When your investments grow and you reinvest the profits, your money starts earning money on top of money. Over time, this snowball effect becomes powerful. Someone investing consistently for 20 or 30 years can build serious wealth without doing anything complicated. The biggest mistake beginners make is trying to get rich quickly. They chase hype, buy random trending stocks, and panic sell when prices drop. Smart investors do the opposite. They invest in strong companies, diversify, stay patient, and think long-term. At the end of the day, stocks aren't gambling if you understand what you're doing. They are ownership in businesses that produce real products, hire real people, and generate real profits. When those businesses grow, you grow with them. If you truly want to build wealth, learning how stocks work is not optional, it's essential. Start small. Stay consistent. Think long-term. That's how normal people become financially free. And remember, the earlier you start, the easier it becomes. Time is your biggest advantage.